Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at AST SpaceMobile.
If you find our talks useful, please consider subscribe, like, and comment underneath to support this show. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. This company is one of the most intriguing and really capital-intensive infrastructure plays we've covered in a while.
Right.
It's fundamentally trying to solve a problem that, telecom and satellite companies have been grappling with for decades.
And what's that exactly?
Truly global cellular broadband. The kind that works directly with the phone you already have in your pocket, whether you're, in the middle of the ocean or a remote desert.
Okay, so let's unpack that a little because that's where the value proposition really kicks in, right?
Yeah.
The core technological moat here is what they call direct-to-device, D2D.
Mm-hmm.
We're talking high-speed 4G, even 5G, broadband connectivity going straight to a standard, completely unmodified consumer smartphone.
And that is the critical aha factor.
Exactly. You don't need a clunky satellite dish. You don't need a special terminal, not even a different SIM card. It's all seamless, which just completely changes the economics and, the friction for mass adoption.
Well, this D2D capability is their secret sauce, and it's protected by a really formidable intellectual property fortress. They hold over 3,800 patents and patent-pending claims.
Wow.
It covers everything from their unique antenna design to the specific waveform they use. This IP is what defends their competitive moat against other players who, frankly, are still relying on proprietary user hardware or much lower bandwidth.
But the technology only works if the satellites are powerful enough to bridge that huge distance to a tiny little phone antenna. This is where the sheer physical scale comes in, right?
Absolutely.
We just saw the successful launch of Bluebird 6. That's the first of their Block 2 satellites. And the technical specs for that thing are, well, they're just staggering.
They really are. Bluebird 6 has this immense 2,400 square foot phased array antenna.
Okay, 2,400 square feet. Help me visualize that.
Imagine something like the size of a small tennis court. Deployed, unfolded, in space. This is not a small machine.
Right.
And that massive scale is what's necessary. It's what allows the signal to overcome all the challenges of linking directly to your phone's little internal antenna.
And the result of that size isn't just like a slightly better signal, is it?
Not at all. The array is 3 times larger than their prior models, and critically, it offers a whopping 10 times the data capacity.
10 times.
We are talking about potential speeds up to 120 millipees per cell. That kind of bandwidth in a remote D2D application it's a true step function change in what space-based communication can do.
So that capacity is the bridge to commercial viability. But there's another side to their advantage, right? The distribution.
Yes, exactly. And that's all secured through this really robust partnership ecosystem. They have agreements with over 50 global mobile network operators.
And these aren't small players.
No, we're talking major Tier 1 carriers like AT&T here in the US, Verizon, and Vodafone internationally.
That distinction is so important. They aren't trying to compete with these massive carriers. They're positioning themselves as an extension of their existing services, basically filling in all the coverage gaps.
And that matters so much strategically because it creates these powerful network effects and really high switching costs for the carriers.
Also.
Well, once AT&T, for example, integrates this constellation into their core network, they instantly get coverage over these vast geographical areas where they could never afford to build a tower before.
Right.
That integration means they can offer seamless service, making the partnership incredibly sticky. This really elevates the company above just being a hardware provider. It's a global network platform.
That makes perfect sense. So the technology is validated, the partnerships are in place. But if we connect this to the bigger picture, the whole investment thesis hinges on execution, doesn't it? Turning that validation into global scale.
Precisely. And that brings us to their recent operational successes. The successful launch and deployment of Bluebird 6 back in December 2025 was probably the most crucial de-risking event for this whole project.
Why that one specifically?
Because it proves the engineering for that large array and the high capacity, it all works in orbit. That was the big validation investors were waiting for.
So with the technology de-risked, the focus immediately shifts to the launch cadence. The deployment schedule they've laid out is, well, it's extremely aggressive.
It is. They're targeting 45 to 60 satellites in orbit by the end of 2026.
45 to 60. So to hit that, we're We're talking about launches every 1 to 2 months, starting almost immediately.
Exactly. That timeline is what's necessary to go from just validating the tech to having a scaled service that can actually serve millions of customers reliably.
That cadence honestly sounds like the single biggest execution risk in this whole story. Has any new satellite operator ever hit that kind of tempo before?
It's wildly ambitious, and it's why they focus so heavily on industrial scaling. They've ramped up their industrial footprint to about 500,000 square feet of manufacturing
I
facilities.
saw that. They just added 2 new satellite factories in Texas and Florida.
Right. That vertical integration shows they're making a decisive shift. They are moving out of the R&D lab and into true, assembly line industrialization to meet that 2026 satellite target.
And then this industrial shift is being mirrored on the ground, too. We just saw the activation of their 4th satellite ground gateway.
And that's more than just a communications hub. It's the physical bridge that connects the space constellation directly into a partner's network, like AT&T's.
So that's a key step towards actual U.S. commercial service.
A critical step. It shows the MNO partnerships are moving from signed papers to physical reality.
That's a huge milestone.
What?
But let's pivot, because execution at this scale is measured in capital, and that's where things get a lot more complex for investors. We have to talk about the fuel for this rocket, the cash burn.
Of course. Given the rapid build-out, they are currently pre-revenue in a commercial sense.
Right.
So the company is characterized by significant negative free cash flow. This is driven by heavy capital expenditures, the CapEx and the R&D needed to build and launch a global network.
Which is completely typical for a massive infrastructure story like this. But it also defines the risk. You have to spend billions before you earn a single dollar of revenue.
And that reality is what drove the massive financing headline we just saw. They announced an offering of convertible senior notes due in 2036.
And the goal was to raise, what, between $850 million and $1 billion?
Exactly. To fully fund the constellation deployment through that critical 2026 phase, it's a gigantic injection of capital.
And the market reacted pretty immediately to that.
It did. The sheer size signals confidence from institutional investors, but also near-term fear from retail. We saw the stock drop 7.3% right after, which reflects the standard concern over dilution and, increased leverage.
Let's pause on that. Can you explain why they use convertible senior notes? These aren't just standard bonds, are they?
That's a great question. No, they're a hybrid instrument. They function like debt, so they pay interest, but they also give the buyer the option to convert them into shares of stock later on.
I see.
For the company, this delays cash interest payments and gets them a lot of capital right now. For the investor, it provides some income with the upside potential if the stock soars, but it is the source of that future dilution concern for current shareholders.
So the $850 million provides the fuel, but at the cost of potential future dilution. Now, here's where the strategy gets really interesting. They didn't just load up on new debt.
No, they didn't. They simultaneously announced a concurrent transaction to repurchase $50 million of their nearer-term convertible notes, the ones due in 2032.
And that's a key strategic move.
It's crucial. By removing those 2032 notes, they eliminate about $13.5 million in future interest payments, and, most importantly, they push their main debt maturity out by 4 years. So this isn't just about loading up debt. It's about stabilizing the balance sheet and securing the runway to get through 2026.
In other words, the capital they raised basically mitigates the primary funding risk.
Yeah.
They have the money to build the satellites and launch them. Now, like you said before, it is purely an execution game.
And that brings us back to the two top risks for anyone looking at this. First, execution delays. If they miss that aggressive 45 to 60 satellite target, the revenue timeline gets pushed out, which means more cash burn.
And the second.
The ongoing dilution and negative free cash flow. That will continue until they reach critical mass and start generating real revenue, which is going to keep pressure on the stock price.
Which brings us to market sentiment.
Yeah.
It feels very mixed right now. Cautiously optimistic, maybe.
I think that's fair. There's real enthusiasm for the tech execution, the Bluebird 6 launch, the factory expansion, but there's also that understandable anxiety over the financing and the dilution.
When sentiment is split like this, it's always interesting to look at internal signals.
It is. And we noted that a director, Keith R. Larson, purchased 675 shares a buy, worth nearly $50,000, back in December 2025.
Okay, but 675 shares isn't a massive institutional buy. Should we really read that much into it?
It's not market moving, you're right, but it's a signal. Insider buying during market volatility, especially right after news that spooked the broader street, is often a sign of internal confidence.
Okay.
It suggests someone with deep knowledge of the books and the schedule believes the long-term value outweighs the temporary noise. They're essentially saying, the plan is funded and we believe we can execute.
That reframes the volatility then. It's a potential opportunity, not just a warning sign. So let's look forward. What are the catalysts we should be watching for over the next 3 months in Q1 2026?
The Q4 2025 earnings are expected in early February. And crucially, the focus won't be on revenue beats, because there isn't any.
Sure.
The market will be focused entirely on cash runway, the CapEx cadence, making sure spending is on track, and, most importantly, any updates to the launch schedule to see if they're on track for those 45 to 60 satellites.
And outside of the earnings call, we need to be tracking the operational events,
Right.
the proof that the manufacturing ramp-up is real.
Exactly. Ongoing production updates, potential launch announcements for Bluebird 7 and beyond, maintaining that 1 to 2 month cadence is a running test of their industrial maturity. If they can stick to that, it steadily de-risks the entire story.
Got it.
And I'd also pay close attention to any investor updates on MNO partnership activations or regulatory progress. Every time they announce a new gateway activation or a successful test showing the constellation is talking to a network like AT&T's, the commercial viability just increases exponentially.
So synthesizing all this, what does this aggressive, high-stakes story really mean for a long-term investor?
Well, this is a truly asymmetric play. The risks are clear. Execution delays and dilution are visible, and they contribute to the volatility. But the successful Bluebird 6 launch validates the unique D2D technology, and that $850 million in funding secures the runway they need.
Right.
If they hit that 60 satellite target, they are on a very clear path to becoming a global high-margin cellular network platform by 2028. For patient investors who can stomach the next 2 years of spending and volatility, the trade-off for multi-year growth potential here is significant.
A classic infrastructure bet then. Massive upfront risk for the chance to become an essential utility.
That's it, exactly.
That gives you a lot to think about regarding this high-growth space play. If you enjoyed this analysis of AST SpaceMobile, make sure you hit that subscribe button for more smart wealth with Joshua.